Okay, guys, welcome to my presentation on gifts of legacy. So I'm gonna do a little bit of a slideshow here, and I'm excited to share this with you. So talking about gifts of legacy, I wanted to start out with stewardship because I think that's important. It's something that I think we have to practice. There's a quote by Reverend T.D. Jakes, and I'm paraphrasing a little bit, but it says, if you leave more to them than in them, they will blow it all in one generation. He was talking about trying to set up our children and grandchildren financially, right? Just leaving them funds is not enough because if we leave more to them than in them, it'll get spent. They didn't have to work hard to build this up. They don't have an appreciation for it. So it generally will get spent within one generation. So to carry on intergenerational wealth, buzzwords we've been hearing a lot, we need to teach stewardship to those we care about and we provide for. We're leaving a tool and a facility. Now, the knowledge of how to use it should not and cannot end with you. It can end with us. We have to teach them how to use this and how to perpetuate it for other generations. So to keep these families of ours thriving for generations, it needs to be taught and lived. We have to stress the importance of control and how to grow and protect our legacies. We want to teach them how to control their money, how to use that to benefit themselves and their beneficiaries and heirs. So we talk about gifts of legacy, looking 3 generations ahead. That's a hard thing for some people to do, but you know what? It's a particular thing that grandparents do. They've had the advantage of living a life and living a significant life up to a certain point. And when they've got grandchildren, they're looking at legacy, right? They want to make an impactful gift of legacy. Generally, they're not sure how to do so. I mean, some of the options is leave cash in a will, pay for RESP, but there's limits for overall grants. So, and then some restrictions in getting it out. Buy rental property. That's one they could do, but they may not want to take on the extra work or the uncertainty of that at this point. Or they can give them cash at adulthood if the grandparents are still around and the grandchildren old enough. So there's some of the options. So in the case of what we're going to look at here, typically a grandparent, or could be a parent, godparent, aunt, uncle, etc., they would own a policy. We're talking about a specific policy here, and they pay for it. You have the option of a 10-year payment, 20-year payment, or lifetime payment. And there's reasons for all of those. Okay, it just depends on what they're trying to accomplish. Now, they have the option to make the parents the contingent owners when the grandparent passes. Depending on the age and key responsibility, they could make the grandchild owner of their own policy. Now, if things go wrong and the child passes early, the death benefit is paid out. Let me say this and let me stress this. There is no sane parent or grandparent that wants to see this happen. Nobody sets up these policies hoping to be able to collect on children and grandchildren, right? But life does happen. And unfortunately, death does happen as a part of life. But for the vast majority, if things go as expected, now we have an asset that could benefit the grandchildren's children and grandchildren up to 4 generations ahead or more. Let that sink in for a moment. See how the thought of that excites a grandparent. It does me. So these grandparents want to give a legacy gift, all right? Now we found out from some digging that mom and dad have been contributing $250 a month for each child to the RESPs. Thinking of the future, they want to do their own as well. They're hoping to add their own gift and approach me about setting up an additional RESP. After speaking with them about not having any more grants because they are limited and the parents are already paying over the amount that would qualify for maximum grants, I didn't think an RESP would make as much sense for them. And after some conversation, they kind of agreed. All right, so figuring out what they wanted to accomplish and getting clarity that it was more about giving the children a better start in life than necessarily the tool of the RESP. They just weren't sure what else is available for tax-free growth. So we spoke about the impact that they wanted their gift to make. They could foresee helping with education, possibly, a down payment for home ownership, the opportunity to fund a business, investments, wedding, or even money for the grandchildren's own children. They just wanted to leave a lasting legacy. Those are the keys. So they were beaming when they spoke about possibilities and opportunities they could do and fund for their grandchildren. I asked them, hey, what if your gift could do all of that and perhaps partially fund the grandchildren's retirement as well? They thought that would be nice, but they couldn't see how $75,000 could do all that. That's the amount they had in mind. Now, there was also a concern about what happens if the grandkids don't go to university? What if the grandchildren aren't mature enough and decide to spend the funds frivolously? That is a worry that I have as well, but there's safeguards for that. Was there any way for them to control the funds once grandchildren become of age? Yes. On the remote chance that they may need access to the funds themselves, is that a possibility? Yes. So I kept talking, and we talked about guarantees because as people get older, they love that word. Guaranteed costs, guaranteed death benefits, guaranteed cash values, guaranteed automatic premium loans, guaranteed access to cash values, and tax sheltered growth. You see a little bit of a theme there about the guarantees. Okay, so let's talk guaranteed costs. Let me compare this to, I mentioned earlier, rental property, right? So with a rental property, I mean, your guaranteed cost might be your purchase price right off the bat once you've agreed to that. How it costs you depends on how you're paying and the terms and the interest rates. Now, here's the difference with the policy. The guaranteed costs are determined at the outset. And if you're going to do a 20-year payment, let's say, then you know for 20 years, this is your payment. It'll never go higher. Okay. And that's what it is. And there's some comfort in that. Guaranteed death benefits. Your death benefits are guaranteed, right? You pay your premium, you have guaranteed death benefits, and then you have additional death benefits bolstered by dividends. But there's guaranteed minimums there. There's also guaranteed cash values. And again, dividends will increase that. We'll talk some more about dividends in a little bit. Guaranteed automatic premium loan. Now, this one excited them because life happens. So let's look at it this way first. Let's say you have a rental property and you've been paying on that thing for 15 years. And for some reason, you just hit a rough spot and for 6 months you can't pay. Will the institution that holds the mortgage say, you know what? You've got some equity in this. We'll just tap the equity to make the mortgage payments. Is that what generally happens? Or after 6 months, there'd probably be some foreclosure proceedings and you could lose the whole thing, right? Now, here's the difference with a policy. Guaranteed automatic premium loan says, as long as there is cash value in here, we will tap that as an automatic response when premiums are not paid. So we will automatically use your equity to keep the instrument going. Huge peace of mind, huge advantage. And of course, you also have guaranteed access to cash values. So the key is you can access your cash values and the policy can keep in force and growing. Those may be withdrawn directly or via policy loans or collateral loans to a financial institution. Now, here's a huge thing, okay? Once declared, a dividend cannot be taken away or even reduced by market conditions. Very key. So these grandparents were thinking above 75,000. So we kind of rounded up. We said, you know what? How about 300 a month for 20 years because that outlay is 72,000. So we did that, 300 a month. The way I'd structure it gets a 1-year-old $250,000 of permanent insurance. The premiums for 20 years and the policy is paid off. So it's a total of 72,000 outlay. Now, I want you guys to look at this. The possible cash value in 20 years could be 83,693. The death benefit of about 668,000. Now, if we're thinking with an investment hat, which I know people automatically do, and say, if we invested 72,000 over 20 years and there's only $83,000 of cash available, that is a terrible investment. Well, if we were talking an investment, perhaps a TFSA or something, I would not disagree with you. But this is a totally different animal. And I'm going to show you that over the next little bit. Now, if the grandchild were to pass away, and we don't want that, we're talking $668,000 tax-free. Now, does that make that 72,000 look a little bit different? I would say so. Is it likely that that investment would hit that? Otherwise, very unlikely, possible. okay, but tax-free to their beneficiaries. But we don't want that child to die, so let's plan on them being around. Age 35, this is 14 years after the last payment because the policy was paid off in 20 years. Remember that. The possible cash value could be $214,000 with a possible death benefit of over $1 million. Now we're starting to talk. Okay, that's 72,214. It's more than doubled in the last 14 years. Those dividends are powerful and at work. The death benefit's over $1 million based on $72,000. Do you think that's a great use of the grandparents' money? I would say so, but we're not done. Let's look at age 50. We're talking possible cash value of over $500,000. The death benefit about 1.6. And then at age 65, we'll call it retirement age, $1.2 million in cash. Okay, cash values are there. With over 2.4 million in death benefit, again, based on a total $72,000 deposit, right? There is no property tax that people don't count. There is no house insurance that people don't count. Your outlay was total 72,000. And at age 85 at life expectancy, the cash value could be 3.4 million with a possible death benefit over 4.3 million. 72,000. This is powerful. Do you think that grandparents' money at 72,000, which is now there for an 85-year-old, which is 84 years later, you think their grandchildren could benefit from $4 million death benefit tax-free? I would say so. So here's the reality. Your cash should be accessed to a policy loan or collateralized bank loan. Why is that? Well, let's talk about having a bunch of units in a building. Okay. If you withdraw the cash, it's like selling off a couple of units when you need money. Okay. As opposed to a policy loan or collateralized bank loan says, if I've got this building and I know that it's going to be worth more year every year, if I just borrow against the equity and get my cash that way, then the whole building with all the units will be worth more and it'll be more beneficial to me long term than selling off a few units each time I need some cash. That is where the loans makes a lot more sense, right? Now here's something key. Your credit and debt ratios have no bearing on your access to policy loans. Well, people might say to me, and have said to me, well, my credit is always pretty good, so it's not a bother. It's not a bother. Well, let's look at it from the other side. Let's not look at it as scarcity. Let's look at it as part of an overall plan. If you've got a couple rental properties, like a lot of people do, if you've got possibly self-employment where you're, writing down your income for taxation wise, when you go for loans, does that make things more difficult? Does your debt ratio play a big part, even if your credit bureau looks good? It does, doesn't it? Well, guess what? With a policy loan, it has no bearing. They just want to know, do you have the cash in there? Would you like some? There are some upper limits, but if you wanted 70% of your equity of your cash value, they're just going to ask you, do you want a check or do you want it direct deposited? It does not get reported to your credit bureau, which is huge because now you can have access to cash that does not, again, affect your credit rating. Huge, huge advantages that people don't readily think of. Now, you can use this cash for whatever you want. As the owner, you want to go buy rental property, additional, you could do that. Education of this grandchild or another, you can do that. For the retirement or your retirement, you can do that. Health issues, business purchase. You could even go buy into the stock market if you'd like. And I've got another video where I show how that's done. You can deploy your cash as needed. Now, here's what's key. We're talking about loans. So I would implore that you be a good borrower and you pay back these loans. The key is you get to decide the terms. You get to decide how fast you want to pay back and in what capacity. That is on you to decide. But if you pay it back, then you've got a facility that is now like a revolving line of credit where you can rinse and repeat throughout your lifetime. Or the cash is needed, deployed to do things, make some money and bring back friends, pay off the loan, do what you will of the difference, and rinse and repeat. So the power of dividends. I've been talking about dividends. So while we say dividends are not guaranteed, their importance is truly understated in most cases. The expected dividend change, and this is key, between the last payment of $3,600 and the very next year is almost double. So let me go into that a little more. $300 a month or $3,600 a year is the annual payment for up to 20 years for this policy. The expected dividend at year 20 is about $6,400. That's almost double the annual payment when this thing was being paid for. If I said to you, if you invest some money steadily for 20 years, and then on the end of the 20th year, your expected increase in your funds is going to be more than your annual outlay, almost double what your annual outlay was, would you think that's a good place to put some money? Well, I would say so. So by year 50, it's expected to be 8 times what the former annual premium was, about $32,000. Now, keep in mind, there has been no money added to this for 30 years, but it keeps on growing. And by year 65, it should be 15 times, about $66,000 in a year for dividend growth. Can you think of any investment which allows you to be passive, that doesn't require maintenance, which could do that? Where's the likelihood of getting this done? I'll wait. Nothing? Okay, let's carry on. So, lifetime contributions. There's the option to do that. I talked about a 20-year. I'm just showing this screen because there's the option. So if they wanted to pay to age 100, which is what's considered lifetime, the total outlay now becomes $356,000 instead of $72,000. Possible cash values will be higher because there's different little bit of a structure after 20 years. Look at age 65, 1.7 million with a $3.5 million death benefit. And then of like expectancy, 4.9 million cash values with a death benefit of $6.295 million. And they'd still keep paying if they're alive. There's reasons for that, but we're going to operate with the 20-year going forward for the examples I'm going to show you. Okay, because I think it's very important with grandparents. They want a lot of times they want a finite amount of time where they can have this thing paid off for. So guys, so far I've talked about accumulation. I've talked about building this thing up and what cash values and death benefits look like at different intervals. We have not talked about how do we put this to use. Now, I'm what's called an authorized infinite banking practitioner. This is a policy that we've set up that is put together with the purpose that you can become your own banker. That's a term you will become more familiar with, and you will hear about infinite banking concept. We're going to go into this, okay, and show how powerful these are, and while this is likely one of the best and most fundamental uses of money that you can have. So again, I'm an authorized infinite banking practitioner, one of less than 60 across Canada, and this is my specialty. I help families do this, not just for grandparents doing for grandchildren, but for themselves and for people at all stages of life. But let's continue this example of a grandchild that a grandparent had set up money for. Okay, so at age 35, this grandchild is ready to buy a home and wants to put a down payment of about $150,000. So this grandchild accesses via a policy loan $150,000 and purchases the house. Now he's very strategic because we've been talking about stewardship and how to teach how to use the tools and how to just think differently, or at least in a more efficient way. So he buys a house with a developed basement that has a separate entrance. Strategic thinking. He rents that out for $1,500 a month. Now he's been taught to be a good steward and uses that to pay back the policy loan. So in 10 years, he pays back the policy loan and has the $1,500 money available to reuse. He has the money that he's paid back into the policy loan available to reuse at $150,000 for the next opportunity. But he also has continuing $1,500 a month he can do something else with. So this is 10 years later, after being age 35, loans paid off. That provided the down payment. 5 years after that, when this grandchild becomes age 50, he decides he wants to get into a little bit of an investment. He wants to do a flip. So he decides to buy an old house, remodel, and flip it. So he goes to his policy and gets a $450,000 policy loan. Now, we're talking being strategic, and we're going to really show you the power of using the tool properly and being strategic and how that can help you. So, a $450,000 policy loan takes $200,000 as a down payment on an $800,000 buy. He gives himself 6 months to complete the project with no income coming in on the project because it's a flip, it's a gut job, there's no rental. He spends $150,000 on the project while paying the mortgage, overages, because there is always overages if you've done this before, and incidentals. And with $60,000 is what's used out of an additional $100,000 cushion. So again, let's back it up. Borrowed $450, used $200 for a down payment, had $250 left over. The project expectation was $150,000, right, which included mortgage, etc. Now the overages and incidental and the mortgage came to an additional 60 grand. So that's 210. Okay. So 210 used. So basically there's 250 left over after the down payment and 210 was used. So out of that $100,000 cushion that was not estimated to be used, they used 60,000. But because it was strategically planned out, there was no panic because the funds were available and segregated to take care of this. I want you guys to really think about that, right? Because when you have access to funds, you can structure them in a way that's more advantageous to you, that reduces your stress. Okay. So you used a total of 410,000 out of that $450,000 loan. So after 6 months, guess what? The project is completed on time. Yay! And he lists for 1.25 million. Now, here's key. The property is on the market for 6 weeks. And then after 6 weeks, he sells for 1.2 million. Now, it's important if he had used every dollar of that loan or of the funds available and things weren't going well after about 2-3 weeks, which is when he was hoping it would sell, do you think you might have to drop the price a little bit more? Yes. Well, this was built into this formula. So that's why he waited 6 weeks to get the price he wanted. And he got 1.2 million. So out of that 1.2 million, he pays out the mortgage, expenses and fees, realtor fees, etc. So that is 650,000 total. Okay. $450,000 loan and pays back $650,000 and has a difference of $550,000 left. Sorry, $550,000 left. The 650 was the additional mortgage and fees. And then 550,000 was left out of that 1.2 million. With that 550, he pays off the policy loan. Now the interest was 10% a year, right? And he only used it for 8 months. So let's say $480,000 total was the loan balance, paid off the loan, had a gain of 70,000 plus the 40,000 unused from that cushion because he only used 410,000. So basically, there's a gain of about $110,000 in 8 months. Do you think that's a good use of policy dollars? Do you think making 110,000 in 8 months was a good use of money? Was that a good investment decision? How was this done? The policy never got cashed in. The policy continues to grow as it would normally, but the equity or the cash value in the policy was accessed to go and make some more money by using it for a different asset. Now, at age 65, he takes $1 million policy loan and buys an old house with a big lot for $1 million. Qualifies for a $750,000 mortgage because he qualifies for the mortgage, still working, and uses a down payment of $250,000 and is going to do an infill. Now, $750,000 mortgage, had borrowed $1 million in a policy loan, right? So put down $250,000. So out of that million borrowed, he uses $600,000 for building and incidentals, gives himself a timeline of 10 months, right? He keeps the other $150,000 for mortgage cost overruns and incidentals because there is always an overrun somewhere and there is always unplanned things when you do an infill or a flip. But giving yourself the cushion, being strategic, okay, because stewardship has taught you to be strategic Being strategic gives them more options and less stress and headache. So 10-month timeline, okay, out of that $750,000 left after the down payment, 600,000 is planned for building and incidentals, and then the other 150,000 is basically cushion and cost overruns. Okay, next slide. Oh, we're not sliding. Okay, next slide. Okay, so instead of 10 months, the project takes 11 months, and he uses 120,000 of his 150,000 cushion. Does that happen? For any of you who've done this before, does projects sometimes take longer than expected? Do you bite your fingernails really toughly because cash is so tight and you have to go find sometimes bridge financing and interim financing and rack up the credit cards? That $72,000 gift allowed this person to be strategic and not have to worry about that. Think about the power of this. That extra month, while not desired, was not detrimental to this. So bills the infills and list them each for 1.4 million. Well, one sells in 2 weeks and the other in 3 weeks, but they both sold for the asked 1.3 million each, or for the expected 1.3 million each. So that's a total of 2.6 million that came in. So after the mortgage is paid off, because it was 750,000 plus fees, okay, plus the 11 months of mortgage that there was no income off, 900,000 total. So after that's paid out, he has 1.7 million plus the 30,000 of the cushion that had never been used. He pays back the policy loan and interest of 1.1 million, and he makes $630,000 profit. Think about that. Using your policy loan in combination with getting a traditional mortgage, but you keeping yourself in the banker position for all the cost overruns, for the construction costs, by borrowing from your policy, you made $630,000 in 1 year, 11 months, but let's say 1 year. What did the project really cost you? The net cost of it was nothing to you, because this was paid for by utilizing the funds in your policy. Did you have to cash in your policy? No. Think like you have a rental property. Did you have to cash in on rental property to go buy something else? No, you tapped the equity. You tap the equity because it's a generational asset, and it would be foolish to get rid of it in order to get the funds for something else. That's your policy. You tap the equity, but you know what another advantage was? You didn't have to go to a bank to possibly qualify for 65% of your equity to get that at a fixed cost that they would have that requires a minimum payment, and hope you're not over leveraged and get all of this. You didn't have to do that. You went to your institution and you said, hey, I want a policy loan. Loan me $1 million out of my policy because I have over $1 million, 1.2 million in cash. So loan me $1 million out of my policy, and I'm going to do this. Doesn't go on your credit bureau, doesn't affect your debt ratio. There is no minimum payment like you would have with a line of credit or loan for that 11 months. There is none. Interest is tacked on, but you don't have to pay a penny. Your policy with your cash value intact is your collateral. And the insurance company does not care if you pay back in a month or you wait a couple of years. They do charge interest, but you got to concentrate on your project, use your dollars and your time more efficiently, and then pay back the loan because, hey, you might do this again. And in the process, you made $630,000 by doing this. Was that a great use of $72,000 by your grandparents 64 years ago? I would say so. So what you need to know is, look, this is strategic planning. You make this a part of your overall plan. Again, we talk about stewardship. It's not just handing you something. It's teaching you how to use the tool so you can teach your children and grandchildren, and you can perpetuate this for generations, for multiple generations, practicing intergenerational wealth, not just talking about it. You don't have to die to realize the benefits. We showed you someone who was very much alive, who not only built up this policy or had it built up for them, but had multiple points of access while they're alive. The same product can be used for financing your future lifestyle. Now, you can pay for an asset now that will pay your family later. You can access funds tax-free to supplement retirement. Buying earlier is more efficient and compounds faster. Think of a snowball going down a hill. Taxation is the biggest eroder of your wealth. It's not fees or rate of return, it's taxation, right? Well, we don't have that in this facility. So you can guard your heirs from taxation growth. Your funds are in a private controlled instrument, access and repayment on your terms. We talked about that in those two examples. So why not use one of these and make it your warehouse for your funds? And you can move your inventory as needed by you. So again, we talk about stewardship. I'm going to keep on talking about it because these gifts of legacy, this is important. We teach our future generations how to continue this practice and how to use the tool, like the wealthy families have done for generations. Intergenerational wealth becomes an action. It's not just buzzwords, it's an action. The same dollars, many more uses and much farther reach, because the dollars and the control of the dollars are always under yours and your family's control. That is the key to keep those dollars in your bloodline generationally, right? So the dollars stay in your family line as long as you retain your capital. And you deploy your cash at times, as we showed in those two examples with the rental property, with the properties, and you send them out with a mission to return with friends and bring you more value. You have a multi-generational impact because of your foresight and your gift. So you build, you control, you grow, you protect, and you pass on your legacy. Thank you for your time. I appreciate you walking this through with me, and I am available for questions and look forward to spending some more time with you.